Welcome to Warren Buffett's Top 6 Investment Tips You Need to Know. You might think you know Buffett, the Oracle of Omaha, but there are some surprising facts about his investment strategies that could change how you see investing forever. Did you know that Warren Buffett made 99% of his wealth after his 50th birthday? That's right. Despite starting his investment journey at 11, the real magic happened later in life. This fact alone shows the power of his long-term strategies. Buffett's net worth is over $100 billion, but what's more shocking is how he achieved it. His company, Berkshire Hathaway, has a staggering annual growth rate of over 20% since he took control. This is no accident. It's the result of careful planning and unique strategies. In this video, we'll dive deep into 6 of Buffett's most powerful investment tips. You'll learn why patience is key, how to find quality stocks, and the magic of compounding. We'll also uncover his secrets for managing risk, staying within your circle of competence, and finding hidden gems in the market. Imagine turning small investments into millions over time. That's the promise of Buffett's methods. Whether you're a seasoned investor or just starting out, these tips can help you build wealth and make smarter financial decisions. Ready to unlock the secrets of one of the greatest investors of all time? Let's get started. Chapter 1. The Power of Patience, Buffett's Long-Term Game. Warren Buffett often says, the stock market is designed to transfer money from the active to the patient. Patience isn't just a virtue for Buffett, it's a strategy. He believes in buying and holding quality stocks for the long haul. This method isn't about getting rich quickly but building wealth steadily over time. Buffett's approach is all about resisting the urge to react to every market swing. He famously held onto Coca-Cola shares for over 30 years. This patience paid off as Coca-Cola's value grew immensely. In fact, he has made billions by sticking with his investments for decades. An interesting fact, Buffett bought his first stock at age 11. He purchased 6 shares of Citi's Service Preferred at $38 per share. The stock quickly fell to $27, but he held on until it reached $40. This early experience taught him the importance of patience. One key element of Buffett's strategy is to focus on the company, not the stock price. He looks for businesses with strong fundamentals that can thrive in any market condition. For example, Buffett invested in Apple not just because of its tech products but because of its loyal customer base and strong brand. Buffett once said, "Time is the friend of the wonderful company, the enemy of the mediocre." This means good companies will grow over time, even if their stock prices fluctuate. By holding onto these companies, investors can benefit from their long-term growth. Statistics show that long-term investing outperforms short-term trading. A study by J.P. Morgan found that holding stocks for over 10 years significantly increases the likelihood of positive returns. Buffett's success is a testament to this. Buffett's patience extends to his investment decisions. He doesn't rush into buying stocks. Instead, he waits for the right opportunity. For instance, during the 2008 financial crisis, he invested in Goldman Sachs when others were selling. His patience and timing paid off handsomely. The lesson here is clear. Patience can lead to significant gains. Buffett's strategy isn't about quick wins but about making smart, informed decisions and waiting for them to pay off. This approach requires discipline but can be incredibly rewarding. Chapter 2. Quality over Quantity, the Buffett Quality Index. Warren Buffett is known for his focus on quality over quantity. He once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This principle guides his investment choices. Buffett's idea of quality involves looking at a company's fundamentals. He examines factors like return on equity, profit margins, and debt levels. For instance, he loves companies with consistent earnings and a strong competitive advantage, or moat. One unique aspect of Buffett's strategy is his preference for companies with strong brands. Take his investment in Coca-Cola, for example. Buffett recognized the brand's global presence and loyal customer base. This quality made Coca-Cola a smart long-term investment. Buffett also values management quality. He invests in companies led by competent and trustworthy managers. He once said, "When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever." An interesting statistic is that companies with high-quality fundamentals often outperform the market. A study by Goldman Sachs found that firms with strong balance sheets and high returns on equity tend to deliver better returns over time. Buffett's focus on quality doesn't mean he ignores price. He seeks value but not at the expense of quality. This balance is crucial in his investing philosophy. For instance, his purchase of Apple shares was at a time when the company was undervalued but still a leader in innovation and brand strength. Buffett's quality index also includes a company's ability to adapt. He looks for businesses that can innovate and stay relevant. His investment in Amazon, despite being a tech company, shows his confidence in its leadership and growth potential. Another unique fact is that Buffett avoids companies he doesn't understand. This principle of staying within his circle of competence ensures he only invests in businesses he can thoroughly evaluate. It's a simple but effective strategy. Chapter 3. The Snowball Effect. Compounding like a pro. Warren Buffett is a master of compounding. He once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Compounding is the process where your earnings generate even more earnings over time. It's like a snowball rolling down a hill, gathering more snow as it goes. Buffett's strategy is to let his investments grow over decades. For example, he invested in Berkshire Hathaway in the 1960s when it was a struggling textile company. Today, it's a multinational conglomerate worth over $700 billion. This transformation is a prime example of compounding in action. The magic of compounding lies in reinvesting your earnings. Instead of cashing out dividends, Buffett reinvests them to buy more shares. This reinvestment boosts future earnings, creating a powerful cycle of growth. A fascinating fact is that the majority of Buffett's wealth was made after he turned 50. This underscores the importance of giving your investments time to grow. In fact, 99% of his wealth was accumulated after his 50th birthday, showing the exponential nature of compounding. Statistics back up the power of compounding. According to Vanguard, a $10,000 investment earning 6% annually will grow to over $57,000 in 30 years. This growth happens because the interest earned each year is added to the principal, which then earns more interest. Buffett's long-term holdings, like his shares in Coca-Cola, show the benefits of compounding. He invested $1 billion in Coca-Cola in 1988. Today, those shares are worth over $22 billion. This massive increase is due to the steady growth and reinvested dividends. One unique aspect of Buffett's strategy is his focus on companies with strong and consistent earnings. He believes that reliable earnings make compounding more predictable. This is why he invests in companies like Apple and American Express, which have a track record of steady growth. Buffett also emphasizes the importance of starting early. The earlier you start investing, the more time your money has to grow. He often advises young investors to take advantage of compounding by investing as soon as possible. Chapter 4. Circle of Competence. Investing within your expertise. Warren Buffett has a simple but effective principle: invest in what you know. He calls this staying within your circle of competence. This means focusing on industries and businesses you understand. It's a strategy that reduces risk and increases the likelihood of making smart investment decisions. Buffett once said, "Risk comes from not knowing what you're doing." By investing in familiar areas, he minimizes uncertainty and maximizes confidence in his choices. For example, he avoids high-tech startups because he doesn't fully understand them. Instead, he invests in industries like insurance, banking, and consumer goods, where he has extensive knowledge. A unique fact about Buffett is his deep research into companies within his circle of competence. He reads up to 500 pages a day to stay informed. This dedication helps him make well-informed decisions. His investment in See's Candies is a prime example. He understood the business and its potential, leading to substantial returns over the years. Buffett's circle of competence also includes understanding management. He invests in companies with leaders he trusts and respects. He believes that good management can drive a company's success. His investments in companies like Geico and the Washington Post were based on his confidence in their leadership teams. Statistics show that investors who stick to their areas of expertise tend to perform better. According to a study by Fidelity, investors who focused on familiar industries had higher returns compared to those who diversified into unfamiliar sectors. This highlights the value of the circle of competence strategy. One interesting aspect of Buffett's approach is his willingness to expand his circle of competence. He continuously learns and adapts, but only at a pace he's comfortable with. For example, he took his time to understand the tech industry before investing in Apple. This careful expansion ensures he remains confident in his choices. Buffett's circle of competence isn't static, it evolves with experience and knowledge. However, he is careful not to overextend himself. He stays away from areas he doesn't fully understand, like cryptocurrencies. This disciplined approach protects him from unnecessary risks. Buffett's advice is to recognize the limits of your knowledge. He says, it's not how big the circle is, it's how well you define the parameters. This means it's better to have a small circle of competence that you understand deeply than a large one with superficial knowledge. Chapter 5. The Margin of Safety, Buffett's Risk Management Secret. Warren Buffett often talks about the margin of safety as a key part of his investment strategy. This concept, which he borrowed from his mentor Benjamin Graham, involves buying stocks at a price significantly below their intrinsic value. By doing this, Buffett minimizes the risk of losing money. Buffett once said, "The three most important words in investing are margin of safety." This principle allows him to protect his investments against errors in judgment and unforeseen market downturns. For example, if he believes a stock is worth $100, he might wait until it drops to $70 before buying it. An interesting fact is that Buffett's approach to margin of safety helped him during the 2008 financial crisis. While many investors were panicking, Buffett was buying. He invested in companies like Goldman Sachs and General Electric at a time when their prices were heavily discounted, resulting in significant gains later on. Statistics show the effectiveness of this strategy. According to a study by Morningstar, stocks purchased with a significant margin of safety tend to outperform the market by 2–4% annually. This extra cushion can make a big difference over time. Buffett's margin of safety isn't just about price. It's also about understanding the business. He avoids companies with uncertain futures, even if their stock prices seem low. Instead, he focuses on businesses with stable earnings and strong competitive advantages. One unique aspect of Buffett's strategy is his focus on companies with strong cash flows. He believes that businesses generating consistent cash can better withstand economic downturns. His investment in companies like Apple and Coca-Cola reflects this belief, as both have robust cash flow generation. Buffett's margin of safety also involves conservative financial projections. He uses conservative estimates for a company's future earnings to ensure that he's not overpaying. This conservative approach helps him avoid overestimating a company's value. Another interesting fact is that Buffett's margin of safety has a psychological component. It allows him to remain calm during market volatility. Knowing that he bought at a discount, he's less likely to panic sell during downturns. Buffett's success with the margin of safety approach can be seen in his long-term holdings. For instance, his investment in American Express in the 1960s was made during a crisis when the stock was undervalued. Over the years, this investment has grown substantially, proving the value of his strategy. Chapter 6. Finding Hidden Gems, Uncovering Undervalued Stocks. Warren Buffett has a knack for finding undervalued stocks, or hidden gems. These are companies that the market has overlooked or undervalued, offering a great opportunity for savvy investors. Buffett's success in finding these gems is a testament to his thorough research and keen eye for value. Buffett once said, "Price is what you pay. Value is what you get." This quote sums up his approach to finding hidden gems. He looks for companies trading below their intrinsic value, meaning they are priced lower than they're truly worth. One unique fact is that Buffett often finds hidden gems in mundane industries. He invested in companies like Dairy Queen and See's Candies, which aren't glamorous but have strong fundamentals and loyal customer bases. These businesses provide consistent returns and have proven to be excellent investments. Statistics support the effectiveness of this approach. According to a report by T. Rowe Price, value stocks, which are often overlooked by the market, tend to outperform growth stocks over the long term. This is because value stocks are bought at a discount and have more room to grow. Buffett's strategy involves deep research. He reads financial reports, analyzes industry trends, and even visits companies. For instance, he spent years studying IBM before deciding to invest. This thorough research helps him uncover undervalued stocks that others might miss. Buffett also looks for companies with strong competitive advantages, or moats. A moat can be anything from a strong brand to a unique product. For example, his investment in Gillette was based on its dominant market position and strong brand loyalty. These moats help protect the company's profits from competitors. One interesting aspect of Buffett's strategy is his willingness to go against the crowd. He often buys stocks that others are selling. For instance, during the 1970s, he invested in the Washington Post when the stock was cheap. This contrarian approach has led to some of his most profitable investments.